Hey guys, my name is Nicolette Mashile. I am also known as The Financial Bunny. Welcome to The Financial Bunny TV. I'm going to start off this video by saying, Uyasha. Hello guys, we are burning and we're burning from the inside, and I don't think there's enough to stop the fire at the moment, because often when interest rates get hiked, it is the people's pocket that feels it the most, right? And of course, very noble and strategic from the Monetary Policy Committee to hike interest rates once again. I mean, this is like the 9th interest rate hike we have seen since the decrease that happened back in 2020, right? So I want to speak a little bit about that. I want to give you a bit of education behind the repo rate, the prime lending rate, why they hike interest rates sometimes, and what does that mean for your budget. Now, please do remember, none of my videos constitute as financial advice. If you are, however, looking for financial advice, please speak to somebody that is certified and registered with the FSCA. So I am nor an economist, nor am I any expert in this space to speak about this and give you a specific advice or make specific commentary. So I want to focus mainly on the educational part of it. So let's talk a little bit about what happened back in 2020. Back in 2020, it went down to a 3.5. That was the repo rate, went down to 3.5%. So what is the repo rate? The repo rate basically is a repurchase rate, right? So remember, there's a reserve bank. There are what we call commercial banks, and then there's the consumer. So basically, the reserve bank has a charge that they charge the banks to borrow money from the reserve bank. Then the commercial banks are who then borrow money to, or lend money rather. English lend and borrow is always a very confusing one. They're the guys who then lend to the ordinary consumer, you and me, right? So when these guys, the reserve bank, increase or decrease the repo rate, the repurchase rate, it means that the banks must also increase their prime lending rate so that they actually make some money when they borrow to consumers, if that makes sense, right? So essentially, most of the time, it is, if the repo rate is 3.5, it means that the prime lending rate is going to be 7. So back in 2020, we had a COVID-19 pandemic, and the economy slowed down because we were all under lockdown, hard lockdown. So the economy slowed down, and you can imagine also there was no actual money that was coming into a lot of people's pockets, right? In fact, some companies had to retrench. We also saw people losing their jobs, but essentially, so the economy became a bit sluggish. And one of the ways to stimulate the economy was to decrease interest rates and make borrowing even more attractive to consumers, right? So the repo rate was slashed and it went down to 3.5, which made the prime lending rate 7%. So it got people very, very active in borrowing money from the banks, which means that the bank was lending at a much cheaper rate to consumers, right? I mean, in all fairness, there's never really a cheaper rate, but they were lending at a cheaper rate to consumers. So consumers were going in hard, and they were borrowing to buy homes, they were borrowing to buy cars, people were borrowing for personal loans, credit cards, all sorts of different credit facilities. Right, that happened. And then post-COVID, we started seeing inflation flaring, right? Across the globe, by the way. It's not just a unique South African situation. Started seeing inflation. So what is inflation? Inflation basically is when prices of goods and services skyrocket, right? So they go up, they increase. So the cost of your bread is going up. The cost of eggs is going up. The cost of oil is going up. Basically, inflation then also causes a very, very big nightmare for consumers, and that is a rising in the cost of living. Now, when you rise or raise the cost of living, basically it means that for many consumers, they have to now start tightening their belts. But a lot of people, what they do is when that happens, there is certain financial products that they let go of, which is in the long run, is a terrible thing that can ever happen to consumers. But we'll come back to that. So now, what the Reserve Bank of South Africa is trying to do so that it gives us a soft landing and kind of rebalances out this inflation flaring that is happening, they are slightly increasing the interest rates, right? But the problem with increasing the interest rate is that ultimately it comes back again to the consumer's pocket. They're the people that are going to feel it. So you can imagine if you took out a personal loan, home loan, credit card at a specific rate. So generally for the ordinary person, the rate that the bank gives you is not always going to be the prime lending rate, right? The bank will either give you prime minus something or prime plus something, right? And different credit facilities will attract different types of interest rates. One, but also based on your credit profile. So it's very, very common that my interest rate on my home might not look the same as the person sitting next door to me, right? Because it's based on our credit profile. But the basis that they work from is, of course, the prime lending rate. So if you're really a great consumer and they really want your business, the bank will give you prime minus something, right? So that is their way to manage the risk of you defaulting on your loans. All right, so perfect. So you can imagine if you borrowed money to, let's say, for instance, you borrowed to buy a home back in 2020, where the prime lending rate, the benchmark of where the banks were starting to consider negotiating, was sitting at 7%. Chances are you probably didn't get a huge interest rate. Maybe you got 9%, maybe you got 10%, right? Or maybe you even got that 7% or even lower than 7%. Sharp. Now the interest rate gets hiked. Almost 9 times, it keeps getting hiked. It is currently sitting, the prime lending rate is currently sitting at 11.25%. That is the basis. So you can imagine moving from 7 to 11. So that is a change of 4.25 from the interest rate we had in 2020 or 2020, wow, English, in 2020. So now that 4.25 represents an amount of money that, one, you're going to pay on your installment, provided that you've got what is called a linked rate, and I'll come back to it. 2, it means that you are probably going to now qualify for even less when it comes to borrowing a certain credit facility or access to certain money from the bank, right? So that's the second thing that we have to keep in mind, which means that many people right now probably cannot buy property, cannot buy cars. They probably just don't qualify because of the interest rate being, or the prime lending rate, or rather the repo rate being hiked, then the prime lending rate also following suit, right? But it also means that when you look at your statement, I've looked at my home loan and I've done the calculations. It essentially means that even less money now is going into actually tackling the principal amount of money that you've borrowed. So for instance, I was paying 17,000 back in 2020. The interest that was being charged, I think, was coming into around about 11,000 rand. Now I'm paying almost 21, 22 probably with the new rate change. And the interest charge is probably sitting at 16, 17, 18,000, which means that the difference of how much actually goes now to tackling the outstanding balance is even lower. So it means that overall, you are going to pay more money overall, right, on that loan, but not overall, because overall sometimes feels far. You're also going to be paying more money now. So you're going to feel it now. What does that mean? I want you to imagine having 3 different loans. The ordinary person in South Africa may have 3 or 4 loans, right? They may have a home loan, they may have an investment home loan, and they may maybe have a car. Some people even go as far as having a personal loan or a credit card or some sort of unsecured debt, right? Now, a lot of people will say, yeah, but why didn't you fix your rate? Now, if you go back to 2020, most banks were not entertaining the idea of fixing a rate because they would be fixing it at 7%. Right now, it would mean that they would be essentially kind of losing if the interest rate, the prime lending rate is now sitting at 11.25. That means they wouldn't be making their money. So because they've got these very fantastic professionals that sit in their banks who will tell them, listen, the MPC, the Monetary Policy Committee, is going to hike the interest rates in this period. So they obviously are projecting forward, right? Or yes, projecting forward. So they will know that. So they will advise to say, don't be out here fixing interest rates. Granted, sometimes the fixed rate that you would usually get is much higher than the prime lending rate. So they'll add maybe prime plus 3% and then they'll fix it at that. But it usually happens on short-term loans. It rarely happens on home loans. It rarely happens on car loans. Obviously, it's not an impossible thing, but it rarely happens. So that's very important. So let's talk a little bit about what is a fixed and what is a linked rate. A fixed rate basically is I've gone to the bank, I've borrowed money to buy a car, and the bank says, we are going to charge you a fixed rate of, let's say, prime plus 2. So if it's prime plus 2 at the 11.25, it means I would be fixing it at 13.25. Now, that means that for your duration of your loan, does not matter what happens in the market, does not matter if the MPC increases the interest rate, you will not be affected. But it also means you are taking the gamble of saying if the interest rate does get decreased, yours also does not get decreased. So it's very important to keep that in mind. If you have a linked rate, it's also a gamble because you are gambling and saying, look, I don't mind the adjustments of the interest rates if they are to be made. But right now, I need my interest rate at the lowest possible rate that I can get from the bank. So they don't fix it. So when the MPC or the Reserve Bank and the MPC, when they change interest rate, whether they decrease them or increase them, it will affect you. So basically there needs to be a recalculation on your credit agreement as to how much your monthly installment now comes back to based on what is your outstanding balance, based on how much time you've got left on that loan. So this is very important, right? Now, what could we have done as ordinary South Africans to foolproof ourselves, first and foremost, from any interest rate hike? One, you could have, of course, fixed your rate, which, as I have mentioned now, it's not an easy task. And sometimes it does come with a cost of what happens if there is a decrease in the interest rate. The second thing that you could potentially have done is borrowed much less than what you actually have been offered. So if you've been offered a home loan or you can afford to get a home loan, for instance, of 2 million, if you took a home loan of 1.5 million, it means you ultimately are paying less, right? The other thing you could have done, of course, is to put away emergency reserves for situations like this, where you will then still try to keep up with the interest charge that you are being paid to try and make sure that you are lowering the principal amount. So over and above how much the bank is going to say you pay as a minimum monthly installment, you would add on, because the biggest thing you need to do is to tackle that high interest rate linked rate credit agreement. That's a big thing. The other thing you possibly could have done is put in a lot of your money into a high yielding interest rate accounts, right? But now you're fighting with inflation. It's very important to also remember that, because inflation devalues the value of our money. But on the other side, an interest-bearing account basically needs to beat inflation. So as the interest rate also get hiked, it means that on deposits, where you earn interest, you will earn a little bit more money. So those are some of the things that you could have done, right? But now let's say you are in the situation. And for instance, with those 3 loans, even if there's just a slight adjustment of you paying 2,000 or 3,000 Rand more. If you're paying 2,000 Rand more, it's 6,000 Rand that you need to find in your budget, which is sometimes very, very difficult because disposable incomes are becoming smaller and smaller and smaller, right? If you have 3 loans at 3,000 adjustment, it means that you are essentially now paying 9,000 Rand extra, and you've got to find it in your budget. Here's where the spanner comes in, and many people don't think about it this way. Let's be realistic. Yes, in 2020, rates went down, you probably started paying less, and what we naturally do as human beings is to adjust our money behavior to the new payment. So if you are not somebody that was paying extra anyway, you probably just adjusted to the new repayment amount, and your budget now started working with this new repayment. But as these things are going up and up and up and up, you keep trying to adjust, but eventually you get to a point where there is no more space for adjustment. And the crazy thing is that for many people, between 2020 and 2023, there is no incredible jump in terms of their income. And this is where it becomes a little tricky, because if your income didn't drastically change between 2020 and 2023, you are probably somebody that is looking at your budget right now and going, eek, I don't know how I'm going to make it. And one thing that we've seen with behavioral finance also is that the moment things like this happen, people don't want their disposable income to be compromised. A lot of people would rather see a disposable income in their bank accounts left at the end of paying for debt, for loans, for living expenses, including savings and investment. They'd rather see that amount. So what gets the boot? What gets the knock? It usually is savings and investments, insurance policies. Savings and investments and insurance policies. The things that you actually need to keep generally are the things that people start to kind of skimp on, not pay, not pay. Some people even go as far as skimping on debt. Now, all of these things, skimping on your savings and investments, skimping on paying your debt, skimping on paying insurance policies, has a negative effect on the future security of your finances. In the long run, it does not look good. So now the question is, what needs to happen? I am of the opinion that right now, remember I always say you can either eat less cake or you can bake more cake. And yes, I think a lot of people over the years, trying to really weather the storm of the last 9 hikes of the interest rate, have been trying to eat less cake. They've been trying to eat less cake. If you've ever needed any sign right now to bake more cake, this is it. This is the sign to start baking more cake. Guys, we need to make more income. We need to make more income. If you've ever thought, oh my goodness, additional income streams, this whole thing of additional income streams is such a toxic narrative. We're so tired. Mental health is, yes, agreed. But at this point, we need to protect our mental health also by making sure we don't get stuck in money management crisis or budgeting crisis, because all of a sudden your disposable income is at risk. It means right now you do need to find ways to make money. And if you can get paid from foreign currency, it's even amazing. So I am suggesting finding affiliate marketing, finding teaching online. I'm suggesting selling, network marketing, selling goods that people are needing right now. And it's very important now, if you are going to go into the business of selling, to remember that because of the rising cost of living, people no longer buy luxuries. So the luxuries are out of the window, right? Right now, people are even saying, hey, it's better to buy groceries when you need them than buying them monthly because it's a waste of money. People are starting to see their behavior that was actually a waste of money because disposable incomes are shrinking. The interest rate hike is shrinking disposable income. And you need to look at your own finances and ask yourself the question, where do I need to make my adjustments? I always say, I heard this, I don't remember where I heard this, but it's such a good metaphor. They say, when you wake up in the morning, one of the first things you check, or the ordinary person, they check the weather to figure out what type of outfit they must put on. That outfit basically is to guard against any negative effects that the weather may bring to them. So right now, the weather is high interest rates in the country. And if you have a linked rate with high interest rates, it means that you need to figure out what to put on. What clothes do you put on to try and minimize the negative impact that is going to happen? Very important. This might even be the right time to go and negotiate for an increment, a salary increment. This might be the best time to start looking for a better paying job. I'm not even lying to you. This might just be the time. This might be the time to get that side hustle going, because this is the time for side hustles to actually shine. It is absolutely important. Absolutely important. And it's a difficult conversation often to have. I see it even with brands. When I send through my rate card, they're just like, oh, Nicolette, you're so expensive. And I'm like, yeah, because inflation is flaring, cost of living has gone up, interest rates have been hiked. We don't have salary guarantee. Things are not looking great, guys. Things are really not looking great. When I say siyasha, I really mean it. So from all of that education, you do what you need to do with that. And I'll see you guys on the next one. Mwah, mwah, mwah.